lesson, we are introducing the Relative Strength Index, or RSI.
I've not heard of this indicator. This should be an interesting lesson.
RSI is a very popular leading momentum indicator. Like stochastics, it oscillates between 0 and 100. It was developed by Wells Wilder.
Wait a minute, isn't that who developed parabolic SAR as well?
It is well remembered. The RSI addresses a weakness of stochastics because it looks at the average up and the average down price moves of a set of prices and not just the extreme high and low points.
Ah, that's interesting. I take it RSI is used in the same way as stochastics, though.
Well, nearly. Traders use RSI to identify potential reversals, so in that sense, it's used in a similar way. RSI can also help us confirm the trend as well. Let's look at how RSI is calculated.
I'm assuming there's a formula for this.
There certainly is. The formula for RSI is on screen.
Okay, so what does RS mean?
RS is short for relative strength, and it's the average gain divided by the average loss. The trader sets the number of periods that RSI looks back over. Wilder recommended 14, so we'll use that in this calculation.
It would be useful to see this in context. Can you give us an example?
Of course. Let's bring up some data. So the indicator only uses closing prices and, to begin with, looks back at each period to see whether the price has gone up or down. If we are looking at a daily time frame, which we are here for FTSE, RSI will take the difference between the daily closes. If the price went up on the day, it's a gain. If it went down, it's a loss.
Right, I think I'm following.
The average gain is then worked out by adding together the values of all the increases and dividing them by the total number of periods. In this example, that's 14. The same is done for the days that the price has fallen.
Right, and what happens then?
Then the average gain is divided by the average loss and we get the relative strength of the data set. These other parts of the formula are just turning it into a number between 0 and 100. They are applied and we get our RSI.
That's pretty straightforward.
Yes, that's how the first period is calculated. In the next period, say the following day, the way the formula averages the gains and losses changes slightly.
How so?
Instead of looking back like a simple moving average would, dropping the oldest day and adding the new one, it applies something called the average off method.
What's the average off method?
It's a fairly obscure way of averaging something. This method basically takes the previous average gain or loss and multiplies it by the number of periods minus 1, and then adds in the new day of data. This is fairly complicated, but the effect of doing it smooths the RSI line and stops the jogging around we see in some other indicators.
Right, so this part of the calculation smooths out the RSI line to provide us with an easier to follow indicator.
That's right. Again, there is a spreadsheet in the materials section that goes through the calculation step by step if you want to analyze it further.
I'll check that out. Would it be possible to see RSI plotted on a chart?
Absolutely. Let's look at a daily chart for gold. Can you have a go at adding a 14-day RSI?
Let's see. If I find the indicator in studies, go down the list and select it. It's the one that goes on the bottom of the chart.
Yes, most oscillators do.
Right, let's increase its size and check the settings. I can see it's defaulted to 14 days, which is what we want. Are these 80 and 20 the overbought and oversold zones, like the stochastics indicator?
They are. Let's set them to 70 and 30. These are the levels Wilder recommended.
Okay, so these are changed.
Excellent. Well done. Let me increase the number of periods because I want to show you an oversold area as well. You can clearly see by the indicator's highs and lows how it reacts to price changes. You can see here where the indicator has passed the 70% threshold when the price had upward momentum, as well as here and here where the RSI has dropped below 30% when there was downward momentum.
Yes, I see that.
Great! Now that we've set it up correctly, let's move on to the next video, which explains how traders use it.
Okay, so how do traders use RSI then?
Traders use RSI to measure momentum in the price. Remember, momentum is the strength of a price move, not how volatile it is. RSI is a leading indicator, which means it's designed to lead the price action.
Right, so in practice, this would mean it acts as a potential reversal signal?
Yes, that's right. Signals can be generated by looking for overbought, oversold setups, centerline crossovers, divergences, and failure swings. RSI can also be used to identify the general trend.
What's a failure swing? I haven't heard that term before.
Don't worry, we'll look at failure swings in a few minutes.
Okay, sounds good.
Traditionally, and according to Wilder, RSI considers a market overbought when above 70 and oversold when it's below 30. Let's look at our chart of gold. We can see RSI enters the overbought zone here in April and again at the end of August.
Yes, I can see that.
So, both these overbought readings are followed by pullbacks in price. This is when momentum was too strong and gold became overbought. For all its strengths, RSI is still just a momentum indicator, which means in sustained trends, like gold had here at the end of last year, it can cross over into a zone and just stay there, especially if the periods we've specified for the indicator end up being shorter than the trend.
You mean because the trend is longer than the 14 days we've set the indicator up for, it shows a sustained oversold signal?
Yes, you've put that well.
So why don't we just increase the number of periods we set for the indicator?
Some traders do. Some traders check RSI for several period lengths, like we do with moving averages. Try not to change the indicator's parameters to justify your point of view. What if the trend lasted even longer next time? The fact remains that this is a weakness of all the momentum indicators we've seen.
I see your point.
We will come on to how to set yourself up and what exactly to look at in the final module. Like many momentum oscillators, overbought and oversold readings for RSI work best when prices move sideways within a range.
Noted. Thank you.
Okay, now let's look at divergences. This is similar to the divergences we looked at with stochastics. Analyzing the RSI highs and lows against the highs and lows of price can provide insights into the changing strength of bulls or bears. When divergence occurred, Wilder considered this an indication of a potential trend reversal. Let's pull up a chart of daily DAX with an RSI of 14 to explain what I mean. Here, a high in the price is formed in line with the RSI crossing over into an overbought zone and forming a high in its own right.
Yes, I see that.
The divergence occurs later when we see a slightly higher price reached here, but not a corresponding higher high in the RSI level. You can see RSI has actually dropped below the 70% threshold. That's divergence.
So, when a high is reached in price, but that isn't reflected in a higher RSI level, this would be seen as a potential change of sentiment that traders might take advantage of.
That's right. We would consider this a bearish signal because the bulls appear to be weakening. The price saw a new high, but the momentum generated to reach that new high was not as strong. The bulls are running out of steam.
Got it. Thanks for explaining. Is the same true when the price forms new lows but the RSI doesn't reciprocate? Are the bears running out of steam?
Precisely. That's a bullish sign. Okay, let's look at RSI trend lines. We haven't conducted technical analysis on an indicator itself yet, but traders can analyze the trends in RSI to assess trends in momentum. If the price can have support and resistance levels, then why not momentum?
I think I'm a bit lost.
Let me show you. If we draw a trend line on the divergence we spotted earlier, applying the rule about confirming it with 3 touches, we can see that it later acts as a resistance twice, here and here.
Yeah, okay. Does it have to be on a divergence?
No, that was a handy coincidence. Both times the RSI has fallen back, as has the price. We can say there has been resistance to the momentum strengthening.
Right, and is it important when the RSI later breaks that resistance in August?
You bet. Look, the old resistance line then acted as support before the bulls gathered strength and pushed the market higher. RSI has on occasion been better at showing support and resistance levels. This type of analysis on the indicator itself can extend further to patterns, which we are going to be covering in our next module.
So how can RSI help us identify trends then? I thought it was a momentum indicator.
Well, you need strength in momentum to develop an uptrend and weakness for a downtrend. RSI tends to fluctuate between 40 and 90 in a bull market, with the 40 to 50 zone acting as support. In a downtrend, it fluctuates between 10 and 60, with the 50 to 60 zone acting as resistance.
So, depending on where the RSI level sits, we can identify an up or a downtrend in price.
Yes, broadly, it's another layer of analysis we might conduct to understand the trend. We can see something similar with our gold example. Here, where the trend is bearish, RSI is between 60 and 20.
I see that.
Later in the chart, when we can clearly see an uptrend, RSI spends most of its time above 50. RSI pullbacks to the midpoint can be seen by some traders as an additional buying opportunity.
Right, so because RSI stays above 50 most of the time, it helps us confirm it as an uptrend.
That's right. RSI's neutral level is 50. If it rises above, it indicates an uptrend. If it falls below 50, it indicates a downtrend. Traders take this a step further at times and consider an RSI crossover above 50 as a trigger to buy and crossover below 50 as a trigger to sell. These are called center line crossovers. We mentioned failure swings earlier in the lesson. Let's look at them in a bit more detail now.
Ah, yes, I remember these were mentioned. What on earth are they?
So, Wilder also considered failure swings as strong indications of an impending reversal. Failure swings are independent of price action. In other words, failure swings focus solely on RSI for signals and ignore the price. A bullish failure swing forms when RSI moves below 30, bounces back above 30, pulls back, holds above 30 and then breaks its prior high.
I see. So it's kind of like a bouncing ball movement?
It's basically a move to oversold levels and then a higher low above 30. The bears tried to find some momentum as before, but the bulls wouldn't let them.
And can we get a bearish failures?
Yes, these are when RSI forms a high in overbought, then a lower high below the 70 line.
So I'm starting to realise that every indicator has its downsides. What are the limitations of RSI?
Well, it's still just a momentum indicator. It works well in a ranging market, like the second half of the gold example. But like stochastics, it can fall over in sustained trends.
Ah, okay. So where there is momentum for sustained periods of time in a market, in long trends, RSI isn't really useful.
Well, it tells us there is momentum, which it's its job, but if it's being used to initiate trade signals, it can give a lot of false ones in these periods. It can stay overbought or oversold for too long.
Thanks for confirming.
The other aspect I don't particularly like about RSI is some of the analysis methods concentrate just on the RSI figure and ignore price action. I've shown you a couple in this video, like failure swings.
What's wrong with that?
Well, if done in isolation, traders end up trading the indicator and not the price. This can be true of any indicator, but RSI happens to be the one I've picked on to make this point. Indicators are there to provide us with analysis. Remember, trade the price action, not the indicator.
The Relative Strength Index, or RSI, is a very popular leading momentum indicator that oscillates between 0 and 100. RSI attempts to address a weakness of stochastics by looking at the average up and down price moves for a set of prices, not the extremes.
We saw how to calculate it. It uses something called the average off method to smooth the gains and losses. A spreadsheet is available in the student area for anyone wanting to get into the detail of the formula.
Traders use RSI to measure momentum in the price. When RSI is high, it suggests there is upward momentum. When low, downward momentum. Signals can be generated by looking for overbought or oversold setups, centerline crossovers, divergence, and failure swings. RSI can also be used to help identify the general trend.
RSI is considered overbought when above 70 and oversold when below 30. Like many momentum oscillators, overbought and oversold readings for RSI work best when prices move within a range.
By analysing divergences, RSI can tell us about potential changes developing in momentum. When a market's price level reaches a new high, but RSI doesn't, it suggests the bulls might be losing steam. The inverse is true in a downtrend, with the price's lower lows not matching up to lower lows in RSI. This suggests the bears might be losing momentum.
Traders can analyse the trends in RSI to assess trends in momentum. Support and resistance areas in momentum can impact the behaviour of participants in the market.
Depending on where the RSI level sits in the market, we can broadly identify whether price is an uptrend or downtrend. RSI trends tend to fluctuate between 40 and 90 in a bull market and between 10 and 60 in a bear market.
Failure swings are considered by the inventor of RSI, Wells Wider, as a strong indication of an impeding reversal. A bullish failure swing forms when RSI moves below 30, oversold, bounces above 30, pulls back, holds above 30 and then breaks its prior high. A bearish failure swing is the opposite, happening around the overbought line at 70.
Although RSI works well in a ranging market, it starts falling over and giving false signals in sustained trends. This is a consistent issue with momentum indicators.
Well done, everyone. I would like to finish by reiterating that with RSI and all other indicators, it's important to trade the price and not the indicator. See you all again in the next lesson.